Now, with only 3 weeks to go before new norms for the sale of unit-linked insurance plans kick in, the life insurance industry is standing uncomfortably, maybe on the precipice of change.
Change that some life insurers at least believe is something that is necessary, even if they have their reservations on the manner in which the insurance regulator has gone about implementing it.
Well, on Business First this evening, we're chatting with Amitabh Chaudhary, Managing Director and CEO of HDFC Standard Life Insurance. Amitabh, great to be chatting with you. My first question, the life insurance industry, of course, is going through some rather dramatic changes with tighter regulations. How are you viewing this?
Well, these changes in one way are very, very positive for the industry because I think they were imminent, they had to be implemented, and I think the industry was expecting the regulations to move in this direction anyway. What has surprised the industry, or I guess has kind of caused a negative impact, is the pace at which it has happened and the pace at which the change has been implemented. So people have to change their operating models extremely rapidly, and I think that's what seems to be worrying the industry, and that's why all these articles are being written about how it is a bit of a negative. There are some elements of regulation which seem to have kind of swung the pendulum the other way, but I think maybe that was required over a period of time as the industry shows to the regulator and the market in general that they're reacting well to these changes, they're managing the changes well. I'm sure the regulator will kind of start looking at pulling some of these things back to some extent. Now that's a hope. There's obviously no promise from the regulator, but that's a hope.
Well, Amitabh, do you believe that if the IRDA were to push through with these changes in a more staggered manner, it would have been much easier for the life insurance industry to cope?
I mean, obviously the industry would have hoped for that the regulations would have been done in a staged manner. And if you look at the history a little bit, I mean, in January, IRDA did come with a charge cap regime, and I think the indication was that over a period of time they will continue to trend down. What happened from April onwards between let's say SEBI, IRDA, and the fact that the notion around mis-selling, the fact that the notion around too much commission being paid or the distribution cost being too high was building up. And I think that build-up made IRDA obviously react in a much more speedier fashion than maybe what even they were planning. That's my guess. But net, I think 6 months down the line, people will turn around and say that was a very important and a significant change for the industry, and it is good for the industry and obviously for the consumers. Consumers who have a 10 to 15-year view are not going to see any change in their overall costs of buying insurance products. There's the people who had a 5 to 7-year view who will see a huge change in the cost of buying these products, and that will be almost 35 to 50%, which is obviously good for the industry.
Well, Amitabh, no change for consumers, but the life insurance industry expects a 20% shrinkage in workforce after these new guidelines sort of do come in. There's already talk of your company resorting to large layoffs.
Yes, there have been news articles, and frankly written by Economic Times itself, saying that there are rumors about large layoffs. And I think we have said what we had to say in our reply to that query. That as part of our when we review our performance of our people, when we look at where we are, a lot of people are as part of our performance improvement plans are asked to go. They are given enough opportunity to perform, and if they don't perform, as part of any company's exercise of looking at the performance of people, some people are asked to go. That's one. Secondly, please understand that if we had to cut costs because of the high attrition rates in the insurance industry, it is very, very simple to actually reduce your workforce because you can stop hiring. It's quite simple. So because of those attrition rates, if you stop hiring or you decrease your hiring, your numbers will come down anyway. So as far as large layoffs are concerned, I think that's not a right statement, because we are not laying off people. We are, from a performance perspective, some people are being obviously asked to go, which is a regular feature in our case. Second, yes, we will have to reduce our hiring because we have to rationalize our costs. Third, yes, we'll be looking at our branches and seeing whether we need all the branches we have. That does not mean we'll not be adding branches, but in some cases we'll be adding branches, but in some cities we'll be reducing our branches because obviously they don't make sense, they're not profitable, they're not generating the revenue they should be, etc., etc. So no large layoffs, but yes, I would expect an overall shrinkage in the insurance industry workforce because a lot of companies are facing a similar situation. Frankly, I would say that amongst the 23 private insurance players, we are much better placed in our cost structure than I would say a majority of them. So even if we had to rationalize our costs, the work which we have to do is much lesser than what a lot of others have to do, if they want to be profitable. I mean, unless if they don't want to be profitable, they don't have to do anything.
All right, Amitabh Chaudhary, many thanks for taking us through what the challenges for the insurance industry ahead really are. We're going to take a very quick break on Business First, but up ahead we track Wall Street for you. Stay tuned.